The market's acting wild, but what's new? Is it a bear market? Is it a bull market? Or is it perhaps a kangaroo market? That's why people watch CNBC, just for their creativity. They're really good with animals. But let's get into our weekly market review and figure out what's happening. Because it looks like the market is having a little trouble staying up. Right now it's teetering on its 200-day moving average. So what's more likely here? Are we going to break lower and go back to lows? Or will this bull trend continue? Let's figure it out. And before we get into it, remember, we got this free training that teaches you the exact strategy that I use in the markets, regardless of which way the market is going. A bunch of our fallible people use it too, and they love it. So you can learn how to use it yourself in this free training. There's a link to get to it in this video and down below in the description and comments. Check it out. Now, as always, we're going to go back to MacroOps, our macro research firm, to figure out what's happening with the market. And here's a good quote from Hunter S. Thompson to kick us off. History is hard to know because of all the hired BS, but even without being sure of history, it seems entirely reasonable to think that every now and then the energy of a whole generation comes to a head in a long, fine flash for reasons that nobody really understands at the time, and which never explain in retrospect what actually happened. Now that quote feels pretty relevant to today's times, which is obviously why Alex put it in here. But of course it applies to the market, everyone wondering how this market is going up when we're in a terrible recession. And not only that, but it applies to the huge social uprising that we're having. And honestly, as far as the social stuff goes, I think this is just the beginning. We talk about this in so many videos, how we're at the end of the long-term debt cycle. And when that happens, a lot of things change because a lot of people are mad. And the crazy wealth inequality that we're just adding to right now with the way this market is moving, well, that's not going to help. That's just fuel for the fire. And that fire is still coming. Anyway, we often talk about how in the market, there's only one real thing that matters. Not an individual company's fundamentals, not technical analysis on some charts, but really everything in the market comes down to supply and demand. Who's trying to buy stocks and who's trying to sell them? And what makes up the demand side for stocks is how much money, which is cash plus credit, is in the economy. So when the Fed is lowering interest rates and pumping all this money into the economy, then what's going to happen? There's going to be way more demand for stocks because everyone has more money to buy them. It sounds super simplistic, but it's what actually moves the market. So it's no coincidence that we saw record money growth coincide with the S&P's best quarter this century. This relationship is very clear when you look at this chart. More money in the economy, more stocks are going to go up. And you could get even deeper into the numbers. Alan Sukaliski is how I think you say his name. He says the stock market is not based on fundamentals because there aren't many. It's based on money, which there is plenty of. So through the data, you could see that the stock market rises on average 31% 1 year after a trough in the S&P to money ratio. And if you're looking at a trough in that ratio, that means the S&P is very low compared to how much money is in the economy. So a year after that, you could expect returns of 31% because the market shoots up. All that money moves the S&P up, and the minimum return in those periods is 19%. And then 1 year after the ratios peak, which means that the S&P market cap is larger than the amount of money in the economy, returns average negative 12%, and the maximum return is only 2%. So again, more hard data proving that the amount of money in the economy is the biggest determining factor of where the stock market is moving. So this March was a trough, meaning we're likely going to head higher from here. Relative to the economy, yeah, the stock market makes no sense. But relative to the amount of money, yeah, it makes a lot of sense. So you can see here 12-month percentage return after S&P to money trough, like we're just seeing. Pretty good returns. And on the opposite end, the S&P to the peak, pretty terrible returns. And right now we're at a trough, so it's looking good. Now, according to Bank of America's US regime indicator, the US is currently in a phase 4 technical recession. What's that mean? Well, I'm going to tell you. So based off this regime indicator, they have data showing what type of stocks perform best. So if we're in phase 4 right now and moving into phase 1 next, then value stocks might be a good area to start focusing your energies on. Now, you guys know how I feel about all these articles and everything saying that value is going to come back. While I'm sure it's true, I think there's a lot of time to still benefit off growth and momentum strategies. Obviously, I'm biased, but I know these things take much longer to play out than people think. And if I look at these phases right here in this chart of the market cycles, recovery, mid-cycle, late cycle, downturn, value really only outperforms in one phase, the recovery. But as far as mid-cycle and late cycle, where a lot of the gains come from, you're going to want to be in growth and momentum. And by the way, not all these cycles are necessarily equal. Like the downturn phase isn't as large and long as, say, the mid-cycle. So if I had to pick a strategy to work through every cycle, because again, the market doesn't just tell you, doesn't send you a text message saying, hey, I'm in this cycle now, so you need to change. No, it's all about evaluating yourself and trying to figure it out. So if I had to pick one strategy strategy to go through all of these cycles, I'd still be doing growth and momentum. And I know if I'm in a cycle where it doesn't work as well, at least I have my risk control to protect me. Because again, it's very tough to predict when these cycles are changing. That's why you run the same strategy through all of them, with the understanding that, hey, it might not work perfectly in every cycle. That's why you got the risk control. And if we're about to go on a massive run, which you'll see as we keep talking about this data is becoming more and more likely, and going back to my theory about the most pain in the market would be a massive run from here, then again, you're going to want to be in those high flying names because there's a lot of money to be made between now and the top. And then the issue becomes that people that don't have a strategy, they don't know how to get out before the whole thing collapses. So on the opposite end of value is growth, right? So there's a case to be made that those growth names are really overextended right now. The tech index is 15% above its 200-day moving average. So it wouldn't be surprising if we saw some mean reversion in the coming weeks, meaning growth stocks fall because we are at some typical extremes. You can see right here hitting this purple line again. Last time we hit that, we collapsed. Not saying that's going to happen again, but you know, there might be some consolidation and mean reversion here. And I don't disagree with that. I think that growth stocks have had a really nice run and it might be time for a pullback. But that's why in my strategy, I take profits as the stock is moving up. And I feel so good after taking some money off the table because not only do I lock in those gains, but I also move my stop up. So when stuff like this happens, like when all these stocks get too overextended and they're due for a big pullback, I'm much better off because I already took some profits and I moved up my stop. So I know regardless of what happens, you know, I'm going to make money. Might not be as much as I wanted because of the pullback, but again, I'm thinking long term. I'm trying to stay in the game, trying to control my risk. So that's the beauty of taking the right amount of profits off the table. And again, that's the type of stuff we go over in this free training. Now, speaking of value, US bank stocks are near their lowest levels ever on a relative basis against the S&P. They are beat up bad if you look at this chart. This is clearly all Buffett's fault, right? All his selling, this is what caused it. No, not really, but there is an opportunity to buy these bank stocks at these low levels, which is what a lot of people did, and they made some real nice returns. But as we said, these bank stocks have been dropping a bit. And if we look at it from a fundamental perspective, what I would expect is for these stock prices to kind of move sideways for a while, to form a longer term base, not just to recover in a crazy V shape. And that's because, again, of the fundamentals of the economy. All these bad loans on their balance sheets because of what happened with the CCPV, and all these businesses that were affected that can't pay things off. The Fed's printing can't plaster over all of it. But who knows, you know, this market is insane, all driven by sentiment. So maybe they do go back to their highs. But based off this, they do seem to be a great value. And the same can be said about oil and gas stocks. So Goldman Sachs released a note talking about the improving supply and demand fundamentals for the sector. And I know these oil stocks and tankers have been hot lately. Or I shouldn't even say lately, that was what, last month's news? But obviously one of the biggest drivers for oil is production, because that affects the supply side of the equation. So Goldman wrote, is 2020 just a pause in non-OPEC oil production growth? And they said, no, we believe we have come to the end of the delivery cycle of the 2010 to 2014 mega projects. So that's how oil works, right? It's huge capital intensive projects that they put into place years ahead of schedule, and then you see the payout years later. So they had all these projects, right, that went into play, but by 2021, all the non-OPEC projects basically stopped. So the non-OPEC supply structurally stops growing, just as it did in 1988, 8 years after the end of the previous CapEx cycle. And these CapEx cycles are so important to industries like oil. That's what you got to be analyzing. And CapEx is capital expenditures. How much are they spending on like new oil wells to set all that up? Like I said, it's very capital intense, costs a lot of money. And going forward, these companies haven't been investing as much in oil and gas, as in, you know, putting in new projects that will kick off years from now. So then you got to ask yourself, is that underinvestment cyclical or structural? Cyclical means, you know, it's just temporary and it'll change again. Structural means it's more permanent. So Goldman thinks the underinvestment is structural, meaning more permanent, because it's driven by rising shareholder pressure on climate change, which makes it a lot tougher to put a new oil project in. People are making moves to more renewable energy. Oil is not that. So what does all this mean? It means less supply in oil, which is good for the oil price, because less supply means that each barrel is worth more. More money chasing after fewer goods, which would be good for oil and gas stocks. Moving forward, you know, we always got to look at sentiment, right? I guess next to money supply in the economy, I would say that sentiment drives stocks. That's the second thing. So here's a new way to look at sentiment called Farrell sentiment. Or is it Farrell? No, it can't be Farrell. But currently it shows that investors are very bearish. You see this line collapsing to this red line. And what do we know about sentiment? We know that when people are bearish, that's actually good for the market, because that means they have money on the sidelines that they could still pile in. If people are too bullish, that's bad for the stock market, because it means everyone is invested and then there's only one way the market can go, right? When these people start selling. So the more bearish people are, the better off we are if you're buying stocks. So if we look at the Bank of America bull and bear indicator, our favorite colorful little chart, we can see that this indicator lifted off of 0 last week for the first time in a very long time. And you can see it's very clear right here. When it's extreme bearishness, it says it's a buy signal. So it lifted off from 0 to 0.9, which is, less bearish, but still extremely bearish. So it's a good sign for the market. Speaking of bearishness and bullishness, a lot of people have been pointing to the Robinhood traders getting active in the market for the first time as a sign to be bearish, since they're the penultimate dumb money. Retail has always been dumb money in the past. So the idea is if they're bullish, then it's time to start selling. But Alex has a different take, which I agree with. He thinks that everyone is the dumb money. And the time to worry is not when a bunch of Robinhooders are getting bulled up, but rather when the suits and ties on CNBC and their money manager guests are seeing nothing but blue skies ahead. And again, goes back to my theory of the most pain. It's just happening in an order we haven't seen before. Normally the smart money gets bullish first, and then by the time the retail people get bullish, the thing is over. But in this case, the retail people are getting bullish first, and then the smart money is going to come in late because they're stuck thinking about, how bad the economy is. But, we don't care about that. We only care about Jay Powell and his printer, as we should, because as I showed you with this data, that really is what matters. But finally, when those guys, the professionals, when they start getting bullish, that might mean that the cycle is over because they saw enough gains to finally change their mind about being bearish. And they're the last ones to cross over to the other side of the boat. And at that point, all that's left to do is sell. And I'm hoping, if we're all doing our job on YouTube here, retail will be out before the professionals are. And the professionals will get crushed on the downside instead of like every other time when retail got crushed. So let's see what happens. Another thing we can look at is VIX, the volatility index, shows how much fear is in the market. And right now you see this moving average indicator based off VIX bouncing off these lows. This is similar to what it did in late 2008 and early 2002, which is a very positive sign for equities. More evidence that we're going higher from here. And here's a good chart about bull market analogs. And an analog is basically seeing what's happening now and trying to pattern match it to something that's happened in the past. Sometimes it works, sometimes it doesn't. Can't put too much faith in this, but it's interesting nonetheless. And you can see the black line is our current market, blue line is 2007, and then you got all these other examples, but they all followed a somewhat similar pattern. And if the trend holds like 2007, if this black line follows the blue line, then once again, we are headed much higher from here. So as I said, I'm still bullish. I'm still long a bunch of stocks. Do I think this market will eventually turn around? Yes, of course I do. But I also know that it could run much farther than anyone expected, which is why, I'm just going to ride the trend. And as long as my strategy tells me to keep buying, I'm going to keep buying. And if you want to check out what we're doing with our strategy, then definitely check out this free training. Link in this video and down below in the description and comments. Got to ride that trend until it bends. This training will show you how to do it. And if you haven't already, make sure you subscribe to this channel so I can see you in the next video. Stay fallible out there. Bye.